Dividends have been one of the best incentives for a lot of investors to get into stocks and get into the market. Ever since the stock market started, it was almost a given for stocks or companies or shares to pay out dividends. It seems that nowadays there are a lot of growth companies and not very many dividends. So in this video, we're going to go over 3 companies that actually seem to have some potential and seem to be at a discount with very high dividend payouts. So let's take a look at it. But before that, let's just make sure we remember compound interest is super cool. If you can see that compound interest graph. So we'll be going over some compound interest calculations as well, just to see what, let's just say, a hypothetical $10,000 investment would look like if you were to drip it or dividend reinvest back into that stock. So let's take a look at it. So we're going to start out with one of the websites that I actually really love to use for screening stocks. Basically, it's got like a lot of tools in here. It's called macrotrends.net. And it's got a stock screener. It's got a bunch of resources and research tools. But we're going to be using the stock screener. Now, we're going to basically see what kind of companies we could find that have good dividends and potentially see if we want to buy into them. Now, I already have the 3 stocks in mind, but I just wanted to show you how exactly to use this tool. So we're going to do market cap of $5 billion minimum. We'll do a 3% minimum dividend yield. And then if we go over to other, we want a payout ratio. So we're going to use 150, but I'll explain to you what exactly a payout ratio is. So now that brought us down from thousands of stocks to only 234. Now, if you look over here, we just have the overviews and the market caps and all of that. We can actually hit this button right here called dividends. And we can actually take this and filter by dividend yield. So I'll go from top down. Actually, let's go from bottom down. Before we get into the actual stocks, though, I just want to mention something very interesting. So the market's been overvalued for quite some time now, and this has happened, a couple times before. We're talking the Great Depression, the 1960s, 70s hyperinflation area, the tech bubble, which is significantly larger than any of the other ones. A little bit, I guess, of the Great Recession here, but we've been in kind of a bubblish time period from, 2021, even like 2018, 2017, to just about this year. And the recent correction has brought us down, a little bit, but we're still sitting in pretty overvalued territory, especially when you look at the mean and the median. We're basically 2x overvalued on the Shiller PE ratio. Now, taking a look at another indicator, I do not want to subscribe to this, is the Buffett indicator, or the market cap to GDP ratio. Now, we see a couple interesting spots here. We can't really see before 1970 on this graph, but we can see here's the dot-com bubble, here's the housing crash, and this has been us. We've basically been above the tech bubble since 2017. Now, this is a little bit crazy because, we got into COVID. A lot of investors were kind of expecting a really big pullback, but it never happened. We got to 2021, got crazy overvalued, a little pullback. Obviously, GDP is still climbing, but stocks have been climbing even faster than GDP. So we actually hit over 200% ratio with this. We got a motorcycle driving by. Anyways, we got over 200% on this graph recently. And even with the pullback, we are still well above our mean, which is this gray line. And there's some, I guess, there's some people that think that the mean will probably go up over time, and that, these kinds of graphs are super outdated and whatnot. But I just wanted to mention this and just, keep this in mind, because during times when the overall market is overvalued, it is dividend-paying companies and so-called value stocks that end up outperforming all of this super hyper growth, high PE companies. So just something to keep in mind here. So let's jump into our first company. So we're going from the bottom. As you can see here, we've got dividend yields. We got our actual dollar amount for the 12-month dividend, the 12-month EPS, earnings per share, and then the payout ratio. So let's find our first company. So our first company is Target. So this is a, pretty old company. We've got a over 3% dividend yield, which I'm pretty sure that this is a bit of a lagging number, because I don't know if the share price is outdated on this or what. It looks like the share price is correct, but I'm pretty sure the dividend yield is in the 4.5% range. So this might be off just a little bit, just looking at this website. But we can see here, they've got a $4.48 dividend over the past 12 months. They did $9.43 in earnings per share. In this payout ratio, this is basically the earnings per share divided by the 12-month dividend. The 12-month earnings per share divided by the 12-month dividend. And that basically says that 47.5% of their earnings they paid out in dividends. And, some people kind of look at companies and they'll say, anywhere from under 40 or under 60% is considered healthy or whatever, which, it's a good thing to keep in mind. But later on, I'll show you one of the companies that we're going to be looking over. Their payout ratio is over 100%. So just so you know and are aware, earnings per share is net income, and there are a lot of different accounting tricks that can bring this number down. And a company's free cash flow can actually be higher than its earnings per share, because earnings per share includes depreciation, a bunch of other write-offs. So technically, I don't know exactly how Target looks in this realm. It's probably higher free cash flow. But technically, free cash flow is the actual cash being made by the company. So just for you to keep in mind whenever you do, your own research and whatnot. But we'll hit Target here. And this is why I love macro trends. We can go into financials. We've got years and years of everything. Looks like you're using an ad blocker, of course. Anyways, we go over to other metrics. And here we can see their dividend history, and I love how they put it in this graph here. And if we just go to all, it's total history, we can see the dividend yields down here, so the percentages. We can see that around 2017, they were trading at about 4% yield. And right now, we have basically topped that yield. And that basically means that their price has trended down to a point where their dividend payout is, getting higher, their price is getting lower, and the yield is getting higher, which means that it's probably, a more attractive investment for dividend investors. So if we look at the dividend payout history, it's basically gone without any cuts all the way from 1986. So it's one of those things that, if they've been doing it and their financials are looking good and their revenues keep climbing, there's a high chance that they're probably going to keep raising this dividend slowly, and eventually the share price will appreciate with that dividend. So we look at that. Now we can jump over to a website called quickfs.net. So this is another one that I really like using. But we'll just check out Target, and this you can look at the financials on macro trends, but I like this website as well because it has nice 10-year compounded annual growth rates on here. So they've raised their revenue by 3.9%, their free cash flow by 4.9%. They got a return on invested capital of an average of 12.5%, and their price to earnings ratio right now is 10.5. So honestly, this is all looking very good. Their revenue does look like it's kind of flatlined a little bit after 2022, which could be cause for concern, but they also had something like that happen from 2016 to basically 2020. So it just, when you're looking at companies like this, you kind of have to take into account all of these different numbers. But we can look at, I guess, the health of the company. It's a store. They're not going to have very high net margin, but their margin has improved a little bit, at least in the, it's pretty much been stable, actually. I was looking backwards on it. So 3.8%. So I think that that's pretty decent when you're comparing stores, grocery stores, things like that. And if you can see here, their free cash margin is a little higher, which means that their free cash flow is higher than their net income. So if we go to their income statement, we have our 2025 net income, which is $4 billion. And then we go to our cash flow statement. And this is usually a calculation that you have to do, but this website does it for you, which is awesome. They got just under $4.5 billion of free cash flow. So just about 10% higher. So anyways, we're just checking that they're going to be good for their dividend. They're paying out only half of their free cash flow in dividends, and we're basically potentially going to be able to lock in a really good yield. One other website I like to use is TradingView, and it's tradingview.com/screener. So we can just check out analyst estimates here. So we go to forecast. You can look at financials on here as well. You just will be limited to how many years you can see. But we can just look at analyst estimates, and analysts think that it's going to be growing its earnings per share annually. So if you don't want to do super deep dives, like, these are really quick resources to see how everything would look. So now let's look at what an investment in Target would look like if we just threw in, let's say, $10,000 into it. So we've got quarterly dividends. I guess their growth rate on dividends has been 7%, which is nuts for their average growth rate. I mean, we could possibly bump that down. Let's say like 4% in perpetuity. Share price growth. I mean, based on what we saw on the forecast, it's probably going to be higher than this. But let's just try to see. We're going to do $0 of extra investment. Let's just say we put in $10,000 today at this share price, which I think is outdated. I think it's lower than this right now. And let's just see what we would have after 30 years. So on year one, if we put in $10,000, we would get an annual dividend of $466. Okay. Now here comes the magic of compound interest. And this is not even talking about investing more cash. This is just a $10,000 flat investment, just leaving it there with the DRIP option, the Dividend Reinvestment Program, which a lot of brokerages offer. So at year 30, it looks like we would have an annual dividend of about $9,337, and our total balance would be $111,000. So this is kind of crazy, and this is also assuming that you're reinvesting, at the current dividend yield rate. If we say that the share price grows, 5% per year, this is definitely going to impact it, because then you're buying, the stock at a more expensive price, i.e. a lower dividend yield, I guess never mind. I guess it would get higher. That would be only if you're adding more money. But either way, either scenario, we're sitting at over $100,000 and, a good annual dividend just from that $10,000. Like, you're basically almost covering your, depending on how it goes in the future, you're basically covering your initial investment with just 1 or 2 years of dividends. So that's Target. Pretty awesome company, I would say. I've been buying a little bit in the $10 a day challenge, and with the stock market being so volatile and a lot of potential for more downturn and more pullback, I'm getting a bit excited, and I'm starting to take a look at a lot more dividend companies. So let's see what our second one is. It's going to be TROW price. I got to make sure I find it on here. It's pretty high dividend yield. So here we go. So let's do TROW price. Now this is basically a retirement account company, like an investment company, and they do mostly retirement accounts like 401ks, 437Bs, and whatever they are. I forgot the numbers. But we'll go to other metrics. We'll go to dividend yield, and look at that. Nice, steady growth of their dividend. We go to all, and really only around 1996, 97, they had a little bit of a drop in their dividend yield. But other than that, they've been raising ever since then. So, almost 30 years of consistent dividend raises, not to include these, it looks like special dividend years that they had 3 times. So, looking at the dividend yield on the bottom chart, this thing's been yielding, I would say probably an average of like 2 or 3%, and really only recently started yielding 4% on average over the past 5 years. We're kind of jumping back up, and I'm pretty sure that the most recent calculation, let's see if we got it on here. Pretty sure the most recent calculation we hit over 6% yield on TROW price. So let's go to our quick FS real quick. We'll enter in TROW. Really good return on invested capital, great revenue growth, great asset growth. Free cash flow growth is a little bit slow, but their earnings per share growth is high. So that return on invested capital is crazy good, and the price to earnings ratio is super low. And here we see that revenue growth, also kind of stagnated over the past 4 years, like Target. But then before that, this is a company, since it's investments related, it's going to be very correlated to how the market performs. So this might be a little bit more of a risky play. But if we go back here and we look at their payout ratio, they're at 54%. And then if we go to their cash flow statement, they got a free cash flow of $1.2 billion. Let's see their income statement. Income statement, $2.1 billion. So actually, it might be a little bit more risky. They might actually be paying almost all of their free cash flow in dividends. So that's a little bit interesting. Just something to pay attention to. They have had some years where their free cash flows have been higher than their net income. Looking at their key ratios, this looks beautiful. We've got almost a 30% net margin. On average, I would probably say this is about 30%. Then their free cash margin has been higher, in a couple years. The past 2 years, it was lower than their net income. So, they've had some accounting type stuff done to manipulate those numbers. But either way, these numbers are looking very, very healthy, I would say. And if they potentially, make lower amounts of money in the future, they could potentially cut their dividend. But there's been crazy stuff going on in the market over the past 30 years, and these guys have been raising their dividends. So definitely interesting to see. So let's see what the analyst estimates are on the forecast. Just a reminder, compound interest is cool, all right? Make sure you don't forget that graph. All right, so for TROW price, analyst estimates basically flat. A little bit lower, and then, yeah, I would say flat. So it makes sense. Honestly, a lot of, economists, analysts, myself included, believe that the market is probably not going to return the amount, as much money as it has over the past 15 years. And, it's times like this where dividend paying companies could potentially get you higher returns than, just a broad index. So we're doing TROW now with a $10,000 initial investment and just going to keep it there. We're going to have 0 on monthly. Let's just say we're going to have it in there for 30 years. then we calculate that. And this is looking pretty nuts. A little bit bigger than, well, a lot bigger. What is going on here? That's why. So with these calculations, we're assuming that with the $10,000, we'll get to $8 million and annual dividends of $3.2 million. Yeah, I don't think that's going to be possible. They have had, I guess, a crazy growth rate in their dividend, but honestly, if we'll just say about a 4% dividend growth rate, and let's just say that their share price stays at 0, and just see how that looks like. So this is a little bit more realistic and actually better numbers than our target calculation. So it looks like we would end year 30 with $225,000 in the account, and we would be getting a over $35,000 annual dividend, about almost $3,000 a month. So that's, for putting in $10,000 and forgetting about it and turning on drip, that seems like a good one. So last but not least, let's do our third one. And this one's a little bit interesting. I'm not sure that, everybody watching will like it, but I know that I like to diversify a little bit, and, pharmaceuticals might be one of those things that I like to be in, at least, a small percentage of the portfolio. And so Pfizer, let's go to all. So look at this yield down here. This yield has only been seen around the housing crash, and they did cut their dividend by almost 50% back then. But even with that 50% cut, they were still yielding 3.5%, and then yielded about that for a long period of time. And their price went up, and obviously their dividend went up. So they've been basically raising their dividend for 15 years or so nonstop. And then before the housing crash, they were raising it all the way from 1986, which maybe all of these graphs only go back to 1986, which I'm not 100% sure. But, this is what's really attracting me here, is this dividend yield. Obviously the price coming down causing that. So let's take a look at what Pfizer looks like on QuickFS. So, an okay return on invested capital. It's very cyclical. As you can see, they have some years where it hops up, and that's probably, when they make some kind of new drug, it returns a lot of capital to them for them. And in the past couple years, they haven't done so hot. So we'll see if this potentially spikes up and the share price appreciates. Revenue growth, not great. Free cash flow growth, negative. Earnings per share, negative. So not crazy good. Price to earnings ratio is a little bit high for these numbers. Now, if we go to revenue, we can see that during COVID, they had a great time with the drugs that they were selling. But if we look at the just overall revenue growth, if we take out those two random years, we see that there is, somewhat steady revenue level there with potentially a little bit of appreciation. They had, a slowdown here and then a spike here. So overall, they haven't had any negative years. They've had dividends getting paid out. They had earnings per share, jump around quite significantly, but they were still paying. So let's see their income statement. So 2024, they made $8 billion. And their free cash flow was $9.8 billion. Okay. And when we go over to right here, or actually right here, we see that their payout ratio is 122%. That's pretty much how much higher their free cash flow is compared to their net income. So it looks like they're probably paying out, in the 95% range. So, they're able to cover it. It just all depends on their future earnings, and they might potentially cut their dividend, but, who knows? They might continue doing well. So let's do another hypothetical $10,000 into Pfizer. And we'll, of course, adjust the below numbers to make them more realistic. I honestly do not think that the share price is going to go to zero, going negative 4% every year forever. But I do think this dividend growth rate will probably be lower. Just on average over the next 30 years, they might have a dividend cut and then they re-raise it. And then just over those 30 years, it ends up being an average of 2%. Just throwing in random numbers. But let's see what $10,000 with no reinvestment, with no extra investment looks, with just the 2% dividend growth rate and zero share price growth. So we are looking at an ending balance of just over $200,000 with an annual dividend of just under $27,000. So another one that looks, if all of this were to play out, you put in $10,000 and, you have an investment doing this well, realistically, if you'd be getting this high of a dividend from a company, it's probably going to be worth a lot more than just $213,000. But we're just doing a hypothetical here, and this overall just shows you that compound interest does wonders. And potentially, check out macro trends. Do some checks in this stock screener. You can check out all these dividends. You can set this to whatever you want. You can change PE ratios. Check fundamentals, their performance, the stock performance, their compounded annual growth rates, like all this stuff. Even, insider ownership, institutional ownership, all these things to find maybe a couple stocks that check all your boxes and look like a good investment. So thanks for tuning in. I appreciate you guys. Make sure you subscribe if you're not subscribed already. And hopefully we find some nice dividend paying companies over the next couple years and we make bank over the next 30. Thanks for watching, and I'll see you in the next one.